Hello and welcome back from your holiday break. This is Nicolò Carpaneda, or Nico, founder of Monetaria. I left you in mid-July with the latest written blog that you can check on www.monetaria.io/archive with some doubts about an upcoming recession in 2023. Every single economist in the world has been fearing a recession since October 2022, but it seems that the latest growth data that we have captured until the end of July for key developed markets in the US and Europe in general not only did not confirm a recession, but quite on the opposite side has been showing very strong resilience in the US. Q2 GDP growth has been at 2.5% above expectations, but also in Europe. In Europe, we had Italy and Germany with a quarter of negative growth, but the latest consumption numbers for July have been much stronger than expected. But it is emerging now that in August, we are seeing an initial inflection in terms of consumption and therefore in terms of future upcoming growth. The gentle cooling of growth that we are seeing in the very last month, as this video is being recorded at the beginning of September, it is justified by the disposable income of families in the US and in Europe being finally lower and the pile of savings accumulated since COVID being depleted. And so it makes sense to see that finally this stock of extra money has been almost entirely spent. If we look at key economic indicators that we like very much, just because in the past 20 years they had a very strong correlation with economic growth, PMI indices, sentiment indices on what industry experts expect for the upcoming future, they've been very negative for a while, but they have been wrong. In fact, I want to show you in this slide that if we still look at the very latest data as of the 6th of September for European manufacturing PMI, the numbers are going very low. There's an expectation in these numbers for an upcoming recession, upcoming like tomorrow. We can see that real data or real hard data, manufacturing output has been much better than what has been feared. So the PMI indicators that we have commented in our blog for many months have not been as good to predict economic growth, but given the inflection that we are seeing in August, finally we might see a gentle cooling of the economy, and finally we might have still a recession in both Europe and in the US in second and third quarter of 2024, which is what, by the way, a very reputable economic model from the US Central Bank, from the Fed, it is still reporting. Yes, it is true that with this initial slowdown alongside a global disinflation trend, maybe with the exception of Europe with inflation still above 5%, but in general in many regions inflation is going down, not still at the level that some central banks would like, but the trend is very clearly going down. So we might expect the central bank in the US, the Fed, and the ECB in Europe to hike interest rates after many months after a very aggressive tightening of monetary policy. Well, we might see the last hike between now, September, and eventually November at the latest. And this is very important because if we finally get to the last interest rate hike, we might see a pivotal changing moment in the economic cycle, which will also be a changing moment for financial markets. Well, stock markets have done much better than expected year to date in 2023 in both Europe and the US, but also in Japan and in some key emerging markets, which was absolutely not expected as the entire investment industry was expecting a recession. But thanks to resilient economic growth, thanks to a good job of central banks at the end of the tightening campaign containing inflation, stock investors have been more keen to buy than to sell key stocks across different markets. But if economic growth and corporate earnings going forward will cool, stock markets will not have the push that they enjoyed until now. And by the way, they seem expensive, not only in absolute terms, looking at historical valuations, valuations, but also relative to fixed income, as we can see in this chart showing the equity term premium, or how much income equities are paying versus fixed income. So we are noticing equities might do less well between now and the next 12 to 18 months, but also an ongoing rotation, an ongoing sector rotation that we have observed and noticed in August, with investors moving to prefer cyclical sectors until now to starting to prefer defensive sectors. If we move away from equities and we look at the other side of classic financial markets or the fixed income assets, we would have expected in 2023 to see a very good performance of US Treasuries, German bonds, and government bonds in general. But this didn't happen because inflation has been surprising on the upside for a while. Central banks continue tightening, and especially economic growth has continued to do well. Again, we now expect a cooling from this point. The yield offered by safe but also less safe government bonds is now very interesting, at least relative to the recent past and relative to stocks, as we have discussed. And so 2024 might finally be the year of duration, of buying safer government bonds starting from treasuries or bonds, because this market now is paying us very well, and in case of a slowdown and in case of a recession is exactly the type of defensive assets that we might want to have in our portfolio. We close this very quick roundup on financial assets with cryptocurrencies, and we typically only focus on Bitcoin and Ethereum. They tend to behave as normal risk assets, like very risky stocks, but in some cases, in some moments in the past 18 to 24 months, they had an independent behavior which was dictated by new regulations or by the ability to hedge money away from certain specific crises. Well, we have seen a peak in the price of Bitcoin and Ethereum at the beginning of July, and now prices are lower. We are at this inflection point in growth. Like stocks, it might be a period of less interest by crypto investors in the assets, as the economy is justifying less enthusiasm about risk. On www.monetaria.io/blog to see the latest developments, to see the way we manage our own investment portfolios, and I will speak with you very soon.